Hello everyone. I'm going to talk the first question. Form of payment proposed part cash and part share. The buyer company under Airmark has more equity valued than the target company Columbia, and less not did, which guarantees it covered more enterprise value and might be suitable for this acquisition transaction. But the acquirer has just a slight advantage over the other. As the tabled ACC data demonstrates, the choice our stock has the same outcome as the chance 65% stock 35% big cash in the aspect of equity per chance price. And we can draw a conclusion that it's a flexible chance to make the acquisition because of the positive number in target company.
Our acquisition terms are such that the current price is $87.17. The share price offered is $113.51, and our deal terms are such that 65% is in stock and 35% is in cash. However, as per our model, we believe that Under Armour should not merge with Columbia Sportswear. While analyzing our data, it seems that this would not be a fair deal for Under Armour and not be lucrative for either of the companies. It is seen that relatively to Under Armour, the target company has a higher amount of liabilities. Therefore, while acquiring the company, Under Armour will not only add to its costs, but also take on an exceeding amount of liabilities. The earnings per share without synergies is 41.8%. However, with synergies, is 18.6%. The earnings per share of both companies combined is lower than the earnings per share of either of these companies measured on a single basis. Therefore, the merger should not happen. Columbia Sportswear would most probably agree to this, considering how non-profitable the merger would be for it. In addition, the merger would not only allow it to lose revenue, but also the control of its management. We therefore do not have an accretive transaction here, and we suggest not to continue with this merger.
The deal structure of an acquisition is all cash offer, cash and share offer, and all share in case they are overvalued by the market. The evaluation goal is to undertake an accretive transaction, which means that the earning per share of the combined entity is higher than the single company earning per share. Ultimate goal is to have intangible accretive transaction. The figure, the EPS return of the combined entity is 18.6%, and the EPS return on the single entity is 41.6%, which means it's higher than 18.6. We don't have an accretive transaction in this merger. That means we suggest not to proceed with the merger. Usually, the premium price is paid from a company that wants to acquire another company, and it consists of an offer around 30% higher than the market price. The reason and analysis behind this move are to incentives the target company's manager to accept an offer and sell the company. The acquired company will benefit from this acquisition more than 30%. That explains also the reason why such a higher offer. The source of synergy usually come from cost cutting, such as cost saving, unused tax benefits, debt capacity, and cross-selling market access synergies. In practice, the synergies tend to be overestimated. If the merger happened to be a failure in the realization of the synergy, in this case, the acquiring company undertakes a value-losing strategy. Another aspect of the synergy that the company can gain from the merger is pure economical one. In fact, the lower the buck is, the higher the EV is. In the projection of year 2024, the accretion reached 18.6%. That means that the merger transaction do not bring any increase in the earning per share in the combined organization that compared the single one. Plus, the CAGR, we assume, is 3.6%. That means in the same year, the combined companies reach $1,426 million in revenues.
Team researcher Under Armour and Columbia Sportswear. Okay, about the risk, I think I will talking about 4 points. Number one is lack of due diligence. Due diligence is critical to preparing for mergers and acquisition transactions. When purchasing pre-existing assets, it is seller who holds much of the information. Number two is overpayment. Overpayment is a common pitfall of mergers and acquisitions. There can be a lot of pressure from several sides when preparing for such significant transactions. Number 3 is miscalculating scenarios. Several problems can arise if your organization completes a transaction with misguided notion about realizing synergies or ways in which the two companies they are individually. And number 4 is integration issues. If a detailed integration plan isn't in place when a transaction is made, the company involved in the deal must function personally for longer than anticipated, resulting in increased costs over time. Different culture may also pose a challenge. Thanks so much.
The above risk can be seen as internal risk in the acquisition risk. However, the systematic risk posed by both companies by market environment cannot be ignored in the acquisition process. The market capitalization of the acquired company is essential consideration, the main factor in determining the purchase price during the acquisition process. Firstly, the company resilience to risk in the volatile market climate is an invaluable starting point for determining the firm's value. In a regression analysis of the company's volatility index and the company's share price shows a beta of 0.47. This indicates that market volatility has sufficient impact on the share price of the acquired company in this case. Therefore, market volatility has risk of causing the market value of the acquired company to decrease, which is manifested as overpaying in the process for acquisition. Secondly, a basic proxy for global industry manufacturing, the WTI crude oil option price can reflect the cost of raw material for manufacturing. An analysis of oil option price in the target company share price shows the beta of minus 1.73. Analysis suggests that target company share price is likely to be extremely sensitive to raw material costs, and its market capitalization will be directly impacted. This evidence that the changes in raw material costs should occupy an important position in the risk analysis.